This is called a pre-inheritance plan that we've designed over the last 20 years. Brian, let's say you have a $3 million property and you have 3 kids. So you sell the $3 million property, you do a 1031 exchange into 3 different assets. But the 3 kids get to predetermine their inheritance by being on the selection committee for the replacement property. Now, they don't own it, but in the trust, it says upon my demise, Joe gets this, Jane gets that, and son gets this. So it's very clear. There's never a fight. That's what we create plans for, prevent that fight.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owners Association, where real estate investors have found success since 1968. I'm your host, Brian Hamrick from Hamrick Investment Group. This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB & Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com. Hello and welcome to episode 533. At some point, every real estate investor has to ask a hard question. Is this property still working for me, or am I just working for it out of habit? My guest today is Dan Ihara, a national real estate planner who's helped investors complete more than 400 successful 1031 exchanges, deferring over $110 million in capital gains tax. He specializes in helping investors evaluate when a property has stopped performing and how Delaware Statutory Trusts can be used as a tax-efficient transition, not an emotional one. Today, we'll talk about how to tell when an asset has become dead capital, how DSTs, or Delaware Statutory Trusts, actually work in practice, and how to think clearly about next steps when your portfolio outgrows its original strategy. Dan, welcome to the show.
Thanks so much. Appreciate it.
All of that. And I didn't mention that you also wrote a book that just came out. Do you mind telling us about the book and what brought you to write it?
The name is called Property Decisions: Avoiding Family Disputes and Painful Taxes to Create a Legacy That Lasts. And it's coming out on February 23rd. You can go to Amazon and just put my name in or put Property Decisions in, and you'll find it. And the premise behind the book was because for the last 20 years, Brian, we've been helping families transition wealth. Well, essentially, we've met with thousands of families. We've sold over 1,600 transactions in 20 years, over $1 billion of real estate we've transferred. And during that time, we've had enormous number of conversations with families not having a plan, having a real estate plan. And so that's one of the things I'd like to ask your audience. Do you have a real estate plan? And if you don't, is that something that would be valuable to your family?
Let's talk about what would be involved in that plan, because I'd imagine it starts with looking at the portfolio that you've owned for quite a while, because we're talking about exit planning here, or transition planning. Let's look at the assets that we've owned for a while. How do we determine if they're dead assets, if there's any more juice to squeeze out of them, or if it's time to transition them like you're talking about?
The first question is what's causing you to keep it, right? And many people, they keep it because of appreciation. They think, hey, it's going to appreciate, or it has been appreciating. But interestingly enough, Brian, when I ask people, do you know what your cap rate is? Most people don't know. Why? Because they don't know the current value of the asset, nor have they kept up with the expense level of it. And things are changing, and things are changing fast. I mean, property taxes are rising quickly, insurance rates are rising, but yet rental income hasn't really kept up. So what happens in that case? Your cap rate goes down. And it's a silent decrease in value, silent decrease of cash flow.
If your cap rate goes down, the value goes up because it's an inverse relationship. So could you clarify that?
Not necessarily. The values may go up, but they may stay stable. But typically, values have gone up, right, over time. But what happens is we don't consider the return on our investment. We don't consider how it's performing for us because we don't measure it. When I ask people, do you know what your cap rate is? If you're over the age of 40 or 50, you don't know because you haven't really kept track of it. Why? Because you don't care. You don't need the money.
Can you just explain what you mean by cap rate? Because I think we're coming at it from different angles here.
It's how to determine economic viability of an asset. So what we do is we take your net operating income, right? Well, which is your income minus your expenses, and you annualize that. You take that on a monthly basis, you annualize it by timesing it by 12, then you divide it by the value of the asset. Well, as assets rise, you're 100% right. The asset's appreciating, but the income is not keeping up with that appreciation level. And that's what's happened over the last 20 years. That hasn't kept up.
You run through the mathematical formula with your clients, and you're able to show them, hey, you're not making the money you thought you were on this. Like what do you typically find? What do people typically believe? And what do you typically find when you run the numbers?
I'm not in Michigan. I'm in Hawaii. Like in many parts of our country where land values are high, we're finding anywhere from 0 to 2%.
0 to 2% return on is that like appreciation, or is that based on the amount they originally invested?
Is based on the value of your asset, you're generating 2% return, net return, right? That's what a cap rate does you. And so when I do the math, I ask them a simple question: is how you feel about that? They go, wow, that's not real good. I say, yeah, I agree. If you could get 5%, would you? Well, 100% of the people say yes. Well, how do we do that? Well, before we even talk about that, my next question to them is, would you prefer to be an active investor or passive one? See, my demographic that I serve is pretty much the wealthy older adult. It's the 50-year-old or higher. Typically, most of our clients are 65 and older, and they've amassed wealth over time. And what's happened is those properties have become a burden, right? The terrible T's, the tenants, the toilets, the trash, the taxes. And then now we have the insurance rates are rising, right? So they got tired of dealing with that. They got tired of the terrible T's. And so when I ask the question, would you like to be an active or passive investor? All my clients say passive. Nobody wants to be an active investor, right? Why? Because they don't need to. They're retired. They have more money than they can spend. It's just an asset that is appreciated, but they don't want to sell it because of capital gains tax. So I asked them another question is, if you could increase your return on your asset without paying capital gain tax, would you? Well, everybody says yes. And that's the case where I would ask them another question is, do you believe you have to touch the principal of this asset in your lifetime? See, if the answer is no, the best solution is called a Delaware Statutory Trust, DST. And don't get confused by the name because it's in many states. Not in all states, but many of them. Why? Because in some states it doesn't make sense. In Hawaii, it wouldn't make sense, right? Because the land values are too high. What it is it's a trust that owns real estate, right? So you're a co-owner in a trust. You have a shared interest in a trust, up to 500 members in this trust that are accredited. Accredited meaning, from the SEC's perspective, it's a person that has a net worth over $1 million and outside of their primary residence. You can then invest in it, right? And you will get today's rate, you'll get about a 5% net cap rate.
And Delaware Statutory Trust, is this an alternative to doing a 1031 exchange?
No, 1031 exchange is the vehicle. The DST is the replacement property.
This is a way for like someone who truly wants to be passive to 1031 into something that's already kind of set up and turnkey for them, where they're going to get a fixed return.
If they want passive income, I don't know of a better way to get passive income without a tax consequence. Here's a beautiful thing about that. Upon your demise, when it matures, your heirs get it tax-free. You get a step up in basis, no capital gain tax.
5% doesn't sound that compelling when you look at just like what the stock market's doing and all that. So what are some of the other reasons you would do a Delaware Statutory Trust?
The main reason is you don't want to pay the capital gain tax, you don't want the burden of owning it, and you'd like a little bit of income. That's why you do it. See, you can't sell a piece of real estate that has capital appreciation and gain and not pay tax without doing a 1031 exchange, right? There is another route to go. It's called a DST. It's a deferred sales trust. It's another asset, a way to go. But at some point, somebody's going to be paying the tax on that once it's realized. So most of our clients, They just don't want to pay the tax, and they don't want their kids paying the tax. That's why they do it.
Talk about the Delaware Statutory Trust from the sponsor's point of view. Are they taking an existing property and swapping out their existing investors? Or is this like a fund, or is it a single asset purchase, acquisition? What constitutes the underlying asset in a Delaware Statutory Trust?
I am not an expert in that, but what I do know is that the sponsor company takes a property, it's relatively new, and they've taken over the asset and they've increased the rents, and they're getting a net return of roughly around 5% today. They're going to hold that asset for, they say, 3 to 5, maybe 7 years. And upon that time, they're going to liquidate it, and you're going to have to do another 1031 exchange. Right? And then you just keep kicking the can down the curb. The good news for that is you don't have to worry about the tenants. The good news is no capital gain tax. The good news is your heirs get to step up on cost basis in the event you die. But the downside is you're going to have to do another 1031 exchange once that becomes mature. So there's another way you can go. It's called a 721 UPREIT. The 721 UPREIT says that it's designed to have a DST with an agreement for a REIT to buy it. See, today's IRS code, the 1031 exchange does not allow you to sell a piece of investment property and buy into a REIT. But you can buy it through a DST that is designed to become a REIT. And the 721 is another tax code. What allows you to move that asset from the DST to the REIT, right, mechanically. And that typically, I'm told, is 3 to 5, maybe 7 years after it sits in the DST. And then you get an increase of about 1 point increase in your return. But the beautiful thing about this is upon your demise, you don't have to wait for anything to mature. Your heirs can get it tax-free within 90 days because they appraise these assets every 90 days. Every quarter they appraise it. The other good thing about the 721 UPREIT is I'm told that you have access, tax-free access, up to 30 to 40% of the equity without tax. So there's more than one way to do this. But for our clients, they just don't, it's not about, they're not young, they're not trying to build wealth, they're trying to pass on wealth, right? They're trying to protect wealth and pass it on. When you're under 50, all you're trying to do is build, right? And so this is not a product for somebody like that. It's a product for somebody who's more mature, they're retired, and they want true passive income.
One of the other things about Delaware Statutory Trust is that if you do a 1031 exchange, you need to exchange into a like-kind property with the entity that you sold the previous property from. So like Hamrick Investment Group would sell a property, and then the next property, I have to take ownership over it through Hamrick Investment Group. That's the way the 1031 has to work. Now, it becomes more complicated if it's a syndication. Let's say I want to move my money into a syndication. Well, I can't do that because it's a different entity that's going to own it unless they do the tenant in common, a TIC, where they can split it up and offer different ownership. So the Delaware Statutory Trust, the way I came to understand it, was sort of an alternate solution where multiple people can move their 1030, use the 1031 to all invest in the Delaware Statutory Trust under their same entity. But because it's a Delaware Statutory Trust, they get around having to put it in their own entity name. And hopefully I'm not confusing everybody, which I probably am, but does that make sense? And am I correct in thinking of it that way?
To my understanding, it's problematic to do a 1031 exchange from an entity because it's going to follow the taxpayer, right? So the IRS is going to follow the taxpayer. When you have multiple people in an entity, that could be problematic, right? And so what many people do is they dissolve the entity before they do the 1031 exchange. Then either party can do whatever they want with the asset. Some will pay the tax, some won't. But it is problematic to try to do a 1031 exchange within the entity.
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com. If you're thinking of leaving your W-2 job and becoming a full-time real estate investor, one of the greatest costs you must consider is healthcare for you and your family. When I made this transition myself, I found the whole healthcare insurance process to be confusing and frustrating. That's why I'm glad I met Chad Creasy at RCB and Associates. Chad is a professional health insurance agent who helps real estate investors and small business owners understand and choose their best healthcare options. And best of all, his services are covered by the insurance company and won't cost you a dime. If you live in Michigan and are expecting a change in your healthcare insurance coverage for any reason, or losing employer coverage or transitioning into Medicare, then you owe it to yourself to contact Chad Creasy at rcbassociatesllc.com. And how does the Delaware Statutory Trust then fit in with that?
Let's say three people own a property, right? It's in an LLC or a corporation or whatever you might want to call it. What you're going to want to do is you want to dissolve, not necessarily dissolve the asset, but separate the ownership of it so it's individuals if the individuals want to do their separate decisions, right? And the reason why we would do that is because almost always people want to do something differently, right? Because of the needs of life, right? And that's why we're facing that right now with many of our clients. We have 5 family members. 2 want to pay the tax, 3 don't. What do? Right? You got to dissolve it and you got to put it in your own name. And then you can do the 1031 exchange with the 3 parties. Some could go into the DST. You can buy anything you want with the 1031 exchange, as long as it's real estate that you don't live in, right?
You still have to dissolve the entity and take your chunk in your personal name to go into a Delaware DST?
More specifically, just change the name and the title. The entity could stay, but the name and the title would have to be changed because, as you said earlier, if John is selling a property, he has to buy it in John's name. He can't buy it in Joe's name. Tell
us a little bit more about your book and just thinking of this exit strategies and transition planning, like how else you like to inform your clients and where else you might lead them.
I'm not sure if you or your audience knows, but the data says that 70% of families have some level of dispute after their parents pass away. And most of that dispute's because of real estate. See, they don't fight over liquid cash or stocks because that's divisible. Real estate's not divisible. And many of our clients, I'd say the vast majority of 60% or more, have a great percentage of wealth in real estate. And they have more than one child. So if you only have one child, it's no big deal, right? There's no decision to be made. But if you have more than one child, if you made more than one, you and somebody else made another child, then guess what? There's a good chance you're going to be a statistic of failing. And that's why we wrote the book. Our goal is to prevent the family dispute. We believe family matters more than anything. And that's what we're doing is we're sharing with people, how do you build wealth? How do you protect that wealth? And how do you pass it on without paying exorbitant taxes, but also mostly importantly, to keep them loving each other when you're gone.
Don't you find that though there's tension between those who want to just take their profits off the table when that point comes and those who want to kind of grow it? And how do you address that?
It's with questions. What you'll find in our book, we have 62 questions the audience can ask themselves to self-discover their best journey in life, right? And so it depends on what they want. And you want to have that conversation before you pass, right? Because if you don't, now you've got people that have different ideas. That's why 70% of families fight, is because the conversation hasn't been made and clarity isn't clear to the heirs upon my demise of what I want. That's the biggest challenge in America today, the lack of that conversation.
In my experience and just, my sphere, it seems like there are some people who are at that age where they're talking with their families about here's how we're going to do it when we pass away. And they're not afraid to have those conversations. But more often than not, I think people don't want to have those conversations or approach those conversations. So I'm sure that you encounter that quite often. How would you advise the people listening to this to talk to their parents or their children to lay the groundwork to pass on this type of wealth?
I think the first realization is you're going to have to realize you cannot divide real estate. It's not possible. They're going to say, well, my 3 kids are going to get the property. How's that going to work? Well, it might work for the first few months, but what happens when other people have other ideas, right? So I ask the clients really simply, are all your kids alike? They go, no. Do they think alike? No. Do they act alike? Are they in the same economic phase of life? Well, if the answer is no, they're going to have some level of dispute. And that's why attorneys tell us that data of 70% of families fight. So what do? We ask the parents the question, what is your plan? What's your plan such that when you're gone, your kids are going to keep loving each other? And they don't have one. So then we ask them, well, do you need the income to sustain the life you desire? And if the answer is yes, we'll go make more money, right? But most of them, they say no. 95% of our clients say, I don't need the income. Then I ask them, would you like to bless your kids today while you're alive? Or let them fight when you're gone? And they say, well, I want to bless my kids. So what we do is you can sell 1 property and buy 3, right? So this is called a pre-inheritance plan that we've designed over the last 20 years. Brian, let's say you have a $3 million property and you have 3 kids. So you sell the $3 million property, you do a 1031 exchange into 3 different assets. But the 3 kids get to predetermine their inheritance by being on the selection committee for the replacement property. Now, they don't own it, but in the trust, it says upon my demise, Joe gets this, Jane gets that, and son gets this. So it's very clear. There's never a fight. That's what we create plans for, prevent that fight. And what's good is they can decide on doing whatever they want with it. Some want it in Michigan, one wants it in Georgia, one doesn't want it. He wants to put it into something that'll generate 5%. So be it. You could do that. Right? But you create flexibility with planning. And it starts with the questions. And in our book, we walk them through a plan, format, and strategy. It's a methodology of creating this plan. It's all your properties, what are they worth? What are they getting? What is your cap rate? Your longevity, what do you want life to look like between now and the end, right? How much money do you need to live the life you want to live? And what do you want it to look like for your kids while you're around? Then it's other assets that you have. How's that going to play in part with your plan? And then N is the next generation. In your wildest dreams, what would you like that to look like? What kind of legacy do you want to create after you're gone? And that's the plan methodology.
What are some of the other tax saving vehicles or just estate planning vehicles? I'm thinking of like donor advised funds, things that families might set up to anticipate the passing of this wealth.
I think if you don't have a 529, I think that's something that everybody should have. I'm not a financial planner, but I put all my kids through high school, private school, high school, and college for free because I invested it early in my life.
A 529 being a college savings plan?
Yep, tax deferred, right? That thing's going to grow, which it did. I almost couldn't spend all the money. And I didn't have to take any of my money out to pay for my kids' college education. And you can do that for grandkids, right? You can do that for anybody. That's one of the things, and it just depends on the level of wealth you have, right? I think if you're north of your estate tax limits, you're going to want to create things that prevent estate tax from happening. Every state's different. Federal government, I don't even know what the limit is now. I think it was like just north of 5 million. But beyond the threshold of whatever it is, you're looking at 20 to 40% of that going to the government, right? So if you have amassed wealth in your life, then there's things like an ILIT or insurance trust, right? Irrevocable trusts. Putting your assets in an irrevocable trust will shield it from estate taxes. So your kids don't have to sell as much as you have to pay the tax. Because most kids, they're not going to have the money to pay the tax, and they're the ones that have to pay it. So this is just from speaking with, I work with a lot of attorneys, trust attorneys and CPAs. that, again, I'm not that person. I'm just a realtor. What do I know? But I know enough, because I've been doing this for 20 years, how people protect their money and create a legacy with it.
And at what point should people talk to someone like you or read your book? And at what point is it too late for them to do so?
Well, it's never too late. I think this book is applicable for anybody over 30. And I say that because when you're in your 20s, you really don't care about much except you. But when you're in your 30s, you start to care about things. You start to care about life, of building wealth. But you're also in a state where your parents are 50 or 60 or 70. And then you're going to wonder, mom and dad has properties. What's going to happen when they're gone, right? And that's the start of the conversation, right? And the way we pose it in our book is a little bit different, because it's not from the space of greed. It's a space of love and harmony. Because it's not about what I want to do. It's how do we make sure that we all get along after you're gone, right? And that's the main premise of the book.
Tell our listeners how they can find out more about you, get a hold of you, and definitely please plug your book one more time.
I'm easy to find, Dan Ihara, Ihara. You can Google me. There's a danihara.com. If you go to Amazon, you can put property decisions in the search, or you can just put my name in there. You'll find it. Today, the ebook's available up until February 23rd for 99 cents. This is 20 years of our life, and with all the plans that you're going to need to build wealth, protect wealth, and pass it on. The paperback book comes available on February 23rd, and it's easy to find. If you Google me, you'll find me, Dan Ihara.
Dan, last question. What is your favorite hack, app, or AI?
Well, I'm simple. I've been using ChatGPT since it came out, so I've been using that. My biggest hack, believe it or not, is an app called TripIt. I travel a lot, and it organizes my travel life. I was gone 167 days 2 years ago. This year, I cut it back to 114. And if you travel a lot, like I do, it's your best tool that you can find.
Well, Dan, thanks for coming on the show today to talk about exit planning, transition planning. How should families talk about transferring that wealth? And you shared a lot about Delaware Statutory Trusts and some of the metrics you should look at when you analyze your portfolio as to whether you should keep it or sell it. It's been a really interesting conversation, and I appreciate you having it with us today. Thank you.
Thanks so much. Appreciate it.
I want to thank everybody for listening to this episode. I'm your host, Brian Hamrick from Hamrick Investment Group, and you can find out more about me by going to higinvestor.com. That's higinvestor.com. This episode was sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com.
You've been listening to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association. You can find out more at rpoaonline.org. If you enjoyed this podcast, please go to iTunes to subscribe, rate, and review.